Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at the second most popular style of trading, swing trading, and some of the advantages and disadvantages of this style of trading. In today's lesson we're going to wrap up our discussion on the different styles of trading with a look at some of the advantages and disadvantages of position trading. So let's get started.
Position trading, which is also referred to as trend trading, generally involves holding a position for 3 to 6 months to capture a fundamental change in the value of a financial instrument that's being traded. As this is the case, position traders will generally be more prone to integrating at least some fundamental analysis into their trading, more so than will day traders and swing traders. Probably the biggest advantage to position trading is it generally involves the least amount of time of the three trading styles. After they have spent the significant time necessary to learn about trading in general, many good position traders will spend just several hours a week analyzing the markets and making their trades. As they are holding positions for long periods of time, just as with swing traders, good position traders will have their stop loss and profit targets in place before making the trade, requiring the trader only monitor the position to make sure nothing significant has changed since its original trading decision. So, not much monitoring of the trade once the trade is placed. The second major advantage that I think many traders would cite about position trading is that because you are in positions for a long period of time with wide stop loss orders, your positions have room to breathe and are much less likely to get stopped out because of random market noise than with the other two styles of trading. As we learned about in our lesson on swing trading, holding positions over longer time frames generally requires wider stop loss orders. While we've just stated this is an advantage, from a market noise standpoint, it is also a disadvantage from a larger average risk per trade standpoint. So similar to the swing trading disadvantage here, but even bigger because you're holding the positions for a longer period of time here. The stops are even wider than they are with swing trading in general. The second main disadvantage that I think most traders would cite is that position traders miss out on the shorter term opportunities that day traders and swing traders can use to amplify their profits. This is not only true from a length of trade standpoint, but also from a capital standpoint. Because position traders hold positions for long periods of time, their trading capital is tied up during those long periods of time, restricting them from taking advantage of as many opportunities. We're going to go into a bit more detail on how to choose the style of trading which is best for each trader in our lesson on the trader's business plan. But you should now have a good understanding of what each style entails. The last thing I'd like to point out here is that oftentimes different styles work better in different types of market conditions. With this in mind, many traders will learn a bit about each of these styles so they can place longer or shorter term trades depending on the market conditions at the time. That's our lesson for today. In our next lesson, we're going to begin to take a look at the different markets that are available to traders. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section below. And good luck with your trading.